call them goldfish trades, because you know that's the type of brain power that you need to be able to execute some of these. And that's not to discredit what we're doing in the academy as saying it's easy, because it's not. But when it comes to what you need to do in terms of executing, there's no thought process behind some of the trades we take. It's just press the button.
Would you say it's comparable to the casino allowing the games to play, you know, like the roulette table to be played regardless of the different outcomes? They know the data. And because they have the data, they're just confident, let the game play.
Yeah. So,
does that make sense?
So I think, and I think this might cause a bit of a, not controversy, but I think retail trading is you are the player in the casino. DR Academy, with the data that we have, you are the casino. So the casino loses, but it's just not bothered that it loses because it always has the edge. So it'll always make the more money than the player. But I always attribute the DR strategy and the data that we have to us being the casino.
Hello there. If you are a binary trader or a newcomer in trading and you experience constant losses.
So yes, we will lose, but you will make more than you lose. And we have the edge over the retail player. That's exactly how I see it.
Definitely. So there's a lot of weight in that data points. The data point side of things, is that just something that M7's collected, or is it something that has been developed?
So that's been developed with the team that he's got. There's a lot of development that's happening behind the scenes. So we have Lens, which is our data portal. So that's where we go on and extract the data. We've got Metrics now, which is a full journaling system, which enables us to journal trades. It's also being developed to have it's integrated artificial intelligence to be able to look at your trades for the past 6 to 12 months and almost heat map where the higher probability trades are that you've taken over the last 6 to 12 months. That's coming in the future, which I think is amazing. To be able to heat map and give you a higher probability based on your own trading style is insane. It also has a back testing feature in there as well, so you can back test and journal your back testing. We've also got Prism, which is due out, which is the hyper version of Lens. We've got Lewis, who has developed Quantum Weaver, which is our psychology aspects of the academy. There's so much stuff going on, so much stuff, and he's invested a lot of money into it.
I can imagine.
Yeah.
These systems are hard, you know, software-wise, it's actually harder than people realize to develop, and especially at a high level as well. Is this all around futures and like NASDAQ, or is it open to FX and the currency?
Yeah, it's open to FX as well. I mean, the majority of students trade futures. So, you know, we're ESCL, NQ, 6E, 6B. So that's like your Euro, USD, Australian, US dollar, that sort of thing. But we do have data points for Forex as well. So as much as I trade futures, I just prefer to trade because they're less manipulated. We know sometimes Forex and CFDs can be heavily manipulated to a degree. But yeah, the choice of what you want to do is open depending on what your preference is. So if you trade CFDs, great, you can utilize the DR Academy as much as anyone that trades futures. There's no preference, so there's no one way or the other. It's just, I think, a majority of students prefer to trade the futures side of things.
Yeah, definitely. It's very intriguing, and you know, you're not, obviously you're like you and then Kit are like the people I know firsthand and follow and have seen, you know, consistently show trades and just speak on it. Obviously hearing M7, but then also I see countless and growing day by day. More screenshots, more trades, more feedback. And it's incredible to see. You know, me personally, I'm someone who, whenever something new or something is being talked about, I like to look at it, I like to observe it, I like to see and hear the feedback, regardless of whether I want to join it or not, or want to change anything or not. I like to see it.
I think that's important. I think having an open mind to something is I'll always appreciate someone that does that, as opposed to someone that's not tried it and just downgrades it as being something that's not real or a scam or whatever. I mean, JCap, for example.
Kyle,
Kyle, he's part of the academy, so he joined the academy. Whether he's still there or not, I don't know. But he joined, so fair play to him. It might not have been for him, but at least he didn't say, no, it's a load of bollocks, that it's not for me. Phantom, you know Phantom? You heard of Phantom?
Yeah, I've heard
Yeah,
Phantom.
he's now in the academy. Whether it's for those educational things to look at to see, is it for me, is it not? Yeah. Do I want to trade that way, do I not? But at least he's had the openness to go in and see what it's all about.
Exactly.
And I'll always admire anyone that does that, because it's almost like saying, you know, to someone, oh, I don't like that food. And, well, have you tried it? No. Well, how do you know whether you like it or not? It's like...
I'm one of them. I'm one of them.
Yeah,
when
so
it comes to food,
but,
I'm one of them.
So am I. But, like, it's true, though, isn't it? Like, how do you know you don't like something unless you've tried it?
Well, the funny thing, I grew up not having any sauces at all.
Yeah.
Right? Ever. For some reason, when I got older, I must have tried it. Well, I remember everyone growing up used to be like, your food is dry. How do you like dry food? And I'd be like, no, it's not. It's fine. Because I didn't know any different.
Yeah.
Now, when I'm older, I've had these sauces. I'm like, hey man, throw the garlic sauce on there.
Like a kid in a sweet shop.
Exactly.
Yeah.
And now I don't. Now my wife's always ripping me because when we got together, we both didn't have sauce, and suddenly I've started to develop this taste for it. And she's like, I'm disgusted in me.
But it's the same. But it's the same thing, isn't it?
It is.
It's the same thing.
It's the exact same. And I feel like most people's opinions aren't their own a lot of the time.
No.
You know, someone else said that's not possible.
Yeah.
So then they believe that's not possible.
Yeah.
And it's unfortunate because at the end of the day, what we have to remember is just because people have chosen to try and be an entrepreneur or try to be a trader, it doesn't mean that they actually are number one, and doesn't also mean that they're going to have a positive mindset.
Yeah.
A lot of people aren't meant to be entrepreneurs, unfortunately, or traders, but yet they are in the space, which is fine. But they bring that toxic mindset with it.
Yeah.
You know? And that's just reality. That's not just trading. That's every industry. But sometimes we forget. Like, I remember I was very naive when I was younger. I used to think everyone was the same. Everyone wanted the best for each other. Everyone wanted to progress. Everyone was motivated. Everyone wanted to work hard. Yeah. And I spent many years wasting my time trying to convince people to work hard for themselves and build something. And only until I sort of separated myself and just focused on myself did the right people come along. Because now, because I was focused, people could recognize it, so they would gravitate towards me. Yep. And I could also recognize the same, so I could gravitate towards them. Yep. Versus that just being with certain friends and being like, hey, let's all work hard together and we'll grow. And yeah, it might be good you have the idea and the intention's good. Yeah. That's just not the reality of the world. No.
And you hear it all the time on like motivational speeches where people talk about how, you know, you need to cut out that, cut out those people that bring no value to your life. And I always used to think that's a bit harsh. Like, you know, why do we need to do that? But as time's gone on, as I've become older, it's so true. Like how you need to do that, and what you just spoke about there is 100% right. You know, there is almost like a naivety when you're younger to think everybody's got good intentions, and the world's wrapped up in cotton wool, and it's like there's no bad in the world. But I think when you get old and you become a bit wiser and you become a bit more focused, you realise that that's not the case. And being able to be strong enough to cut ties with people is you know, I admire anyone that can do that, because it's a tough thing to do.
It is.
But when they bring no value to your life and they're stopping your dreams from becoming true, because, you know, I've said this before on a couple of spaces that I'd always take advice of somebody that's failed 1,000 businesses over somebody that's never, ever quit a 9 to 5 because they're too scared. They moan about the job. They say how much they hate it. They say how much they wish they had another job, but will do nothing about it. Yet these are the ones that will say, don't do trading. Trading's not right. You'll burn. You'll lose money. It's not. It's a scam. How do you know if you've never tried it? And how do you know if you've never got out your comfort zone? And you're the one that moans about your job all the time, yet you're still in that 9 to 5 job moaning about it. Man, no. I'd rather listen to that person that's failed 1,000 times, that hasn't got a business, but he's tried it over and over and over and over again.
That's right. Yeah.
And that for me is far more powerful than being around those people that are too comfortable with their existence.
Do you know what's funny though? Those same people will always be the ones who come back after you've done it and be like, oh, how do I get involved in this?
Yeah.
You know? And I've seen it firsthand, and you probably have started to see it. If not, I promise you when this podcast goes out and people you know from the past will see it, they will message you.
Yeah.
What are you up to now? Oh, that sounds great. Can you show me this? Can you show me that? Yeah. And it's so interesting, right? It's just so interesting how that works. And it's just, or they'll turn around and be like, can I give you money to trade? You know?
Yeah.
But
and it's the same with the gym as well. Like you get people that, I always get people that message me and ask me for advice. But these were the ones that were saying, "Oh, don't do that. Don't go to the gym. Don't train because it's this, that, and the other." Yeah. And then when you look like that, it's like, oh, okay, that looks a bit good. Let's now ask him how to get there. But you know, the thing is, people want to be in your position until they realise what it takes to play your position, and then it all goes downhill because they just don't want to put in the work. And that's the same with trading. Like people just think it's dead easy. You know, I genuinely thought the academy would be a lot easier than it is.
Oh yeah,
that's humbled me massively because it's not. It's hard, regardless of what anyone says. It's hard. But I embrace that. I embrace the challenge. I embrace anything that's hard because I think the journey of getting somewhere is far better than, you know, the journey than getting there, if that makes sense. Than being there, sorry. So the story of how you got there is far superior because have you ever listened to anybody that's successful? The story that they tell is far more, it's far more engaging than actually talking about the success. Getting to that stage is a lot more interesting. But people, when you talk about hard work and when you talk about, you know, what it takes to get there, oh no, it's not for me, that. It's almost like they think that they're just going to wake up one morning and completely be changed and be able to trade or be able to be massive and be in the gym. Or it's just unrealistic.
I think that's what people expect. They think if they stay long enough close to it, one day it will change. Like there'll be like just a flick of a switch or just a complete 180. When the reality is that doesn't exist. Like you said, the value is found in the journey itself, you know, and embracing the hard. So like you mentioned earlier in terms of, you know, it is hard to cut people off. Right? It is that, and you...
Oh, it's hard,
But the more you do it, not that you just go, cut off. No, but the right people, you know, you cut them off. The first time will be hard. The second time might be hard. But the third time... it'll become easier. And I think it's the same with losses. The first loss you take in trading, hard. You're going to feel it. Second one, you're going to feel it third. The more you do it, though, it's going to get easier if you allow it, though. What a lot of people do, hard, break for 3 to 6 months, come back, hard, break, and then they just keep doing that.
Yeah, I find with a lot of things in life, I think when anything's hard, people struggle with consistency and people struggle showing up. I show up every single day. I show up at the charts every day without fail. I show up back testing. I show up journaling. I show up at lives. I've never missed a live, ever. The only time I missed a live was when did I go to, I had to have an MRI scan two weeks ago. It's the only time I've missed a live in 8 months. Now, they're pre-recorded, so you could go back and listen to them, but I listen to them as they're happening, and I've never missed a one. You know, if Master's talking on one of these Twitter spaces, I'll be listening. If he tells you to do something, I'm listening, I'm taking notes, I'm there, I'm showing up every single day because that's what it takes. It takes persistence, it takes raw grit, it takes total accountability, it takes responsibility for your actions, it takes showing up every day. You just got to do it because you can't rely on just motivation because, when you start doing trading, it's exciting. It's like, oh, like, look at these pretty candles going up and down. That looks cool. When you're showing your friends your screen, it's like, wow, it looks amazing. You don't really know what's going on, but it looks cool. And that's where the motivation kicks in. That's where it's exciting. But over time, motivation sit in front of 5-minute candles going up and down all day is boring as hell. That's where that discipline needs to be coming from. That's where that motivation and showing up every single day. You can't just say, oh, it's been a bit hard for 2 weeks. I'm just going to take another 2 or 3 weeks off and then I'll come back to it. It just doesn't work. At the end of the day, is it right to say we're in control of our futures? Possibly not. But I tell you what we are in control of, and that's time. And how we choose to spend our time is something that we're in control of. And are you going to spend your time flicking through social media, looking at TikTok, looking at your sister's brothers dancing around in his like cousin's underwear for a TikTok video? Or are you going to spend it in self-development? Are you going to spend your time being a victim, moaning about how shit life is for you? Or are you going to spend your time being accountable and proactive to push your life forward? And these are all the things that we're in control of. We are in control of how we spend our time. And that is the one thing that one we haven't got enough of, for a start, because like I'm 40 now and it's like, wow, where's that time gone? But you know, secondly, it's something that we can control in terms of how we spend it. And people don't spend it right. People don't spend their time right, because I'll talk to people who will be in the academy, for example, and when you speak to them about the back testing that they've done, oh, well, I didn't have time. And like when you really drill it down and unpack the reasons, because I like to unpack stuff. I don't mean like boxes, like I used to do with my old job. Yeah. I like to unpack why people are saying what they say, and really drill into the reasons why, because I can't accept that people don't have time to do something in 24 hours. I just find that impossible. Like when someone says, oh, I didn't have time to text you, for example, that really winds me up. Like, seriously, like, come on. You didn't have time, it takes 10 seconds. Like, it's a shit excuse. Or when someone says, oh, I didn't have time to go to the gym. Well, why? Well, I started work at 9 o'clock, right? Well, the gym opened at 5. So why weren't you in at 5? Oh, well, you know, it's dark, it's cold. I didn't really... Right, so it's just an excuse. So for me, you're always in control of that. And how you spend your time is it's down to you. It's not down to anybody else. And for me, that's one thing that I've always been able to manage correctly. So for me, saying to someone, are you back testing or spending time watching Netflix? What are you doing? Well, I watched Netflix today. How much back testing have you done? None. Well, there you go. You chose to spend your time doing something that serves you no purpose over something that's going to self-develop you over time. And that's the difference. And I think that's where a lot of people are in that 99% bracket as opposed to the 1%. Yeah. It's a hard work to get into that 1%.
Definitely, 100%. That's why it's the 1%.
Yeah.
You know, like you said earlier, if it was easy, everyone would do it.
Yeah.
You know, but at the end of the day, you choose if you're in that 1% or not.
Yeah.
You know, and I think a lot of people will hopefully have just listened to what you said there and have a moment of reflection, of accountability. One thing you did mention there is obviously, you know, the time's gone by fast. You're 41. There's going to be people out there who resonate with you or at the similar age. But obviously, as you know, there's a lot who are younger, right? So what would you be able to say for those who are at your age, who may be reluctant in terms of change or think that change can come? Because you've experienced a lot of change in the last, say, 2 years. Yeah. But then also to those youngsters out there who don't understand the essence of time yet.
I think for anyone who's a similar age to me who thinks that life can't be changed at a certain age, just get that limitation out of your head, because it's utter bollocks. We're all in a position to be the master of our own life. And I don't think no matter what age you are, you're always in a position to change it. And it's just, I think a lot of the time it comes from self-belief. I think when you hit a certain age, because you've not done it sooner, there's like a self-belief element that kicks in. But I think if you've got that self-belief to want to change and to want to do better things, then you can, no matter what age. Because for me, did I believe I could change my mindset after 35 years? No at the time, but I have. And change is very, very possible if you want it. You've got to want it. And you've got to want to get out of your comfort zone. You've got to want to be, you know, you've got to want to be happy with being uncomfortable first. And if you can overcome that, then you can overcome anything in terms of how to change your life. But I would say, you know, no matter what age you are, it's never too late to change. I think the only times that, you know, I would advise anybody is like, for me, being at that age, certain people have got commitments like mortgage, bills, family, kids. Can't just walk out of a job when you've got that. So I get that. But there's always workarounds. So there's always things you can do. Like, you know, we have people in our academy that will back test till 2 o'clock in the morning and then go and do a full-time job. I remember watching one of my first YouTube videos I ever watched was Paladin. And I remember watching one of his videos, and he stated on there that he used to sleep on his friend's sofa or a cousin's sofa, a family member's sofa. He used to trade till like 2, 3 o'clock in the morning, lose, and then go do a full-time job. That takes some mental strength. So I think you've got to be willing to do that. You've got to be willing to put yourself in that position. And I always look back at that video because I admire it, because I think, wow, what a guy. Like, where he's come from and where he is now, no wonder he's doing what he's doing, because the guy used to sleep on someone's sofa. Rather than going back and doing a full-time job and earning potentially more money, He'd rather do that because he knew and had self-belief. I think if you've got self-belief, it can really put you a long way.
Yes.
But you can have that no matter what age. And I think for the youngsters amongst us, get yourself off social media. Stop wasting your time on shit that just has no value. Social media brings no value to anybody, apart from if you are able to control who you see and what you see. And that's what I love about Twitter. So I can block certain words, I can block certain people, I can block narratives that bring no value to me at all, and that block list just gets bigger and bigger. But the timeline gets smaller and smaller in terms of the value that I see. So I only have value on there now. I don't have anything else. So I think that's important. And I think, you know, if I could go back to my 20-year-old, I'd give myself a massive slap and say, listen, you'll be 40 before you know it, because time can get taken away so fast. I don't know where the last 20 years have gone. I really don't. But I think youngsters now are in such a great position because we have the World Wide Web where there's so much free content, there's so much free value, there's so many things you can be better at than anything that I ever had when I was younger. We didn't have anything like that. I mean, I remember, I think I was 17 or 16 when dial-up was introduced. And you know, when you turn on your internet and you hear that horrible AOL noise.
Yeah.
Like, kids will laugh at you now because they're like, what the hell was that?
They don't even know what the sound
is.
is.
It used to take like 3 or 4 minutes to connect to the internet. And then if your mum's friend rang, it'd disconnect halfway through messaging your girlfriend on MSN Messenger. And you'd be like, shh, for fuck's sake, mum. But now, the accessibility that these youngsters have is just insane. I'd just say you need to utilize that as best you can. And just understand that, you know, spend your time wisely, because before you know it, you'll be that 40-year-old in your 9 till 5, being swallowed up by that mundane job, and it'll be really, really hard to get out of. Whereas now, it's not that hard to get out of because you're not in it. So yeah, if I could go back to my older self, that's definitely what I'd be taking advantage of.
Definitely. No, I couldn't agree more. I was saying it the other day about being trapped. Yeah. Social media has us trapped.
Yeah.
Our smartphones have us trapped.
Yeah.
You can flip the script. It's like the mind. Like, you either, if the mind controls you, it's dangerous.
Yeah.
If you control it, it's dangerous for you to then, you can take over anything.
Yeah.
Right? Same with the phones. If you use it wisely, like you said, in terms of the accessibility is so strong. But then if you're wasting time scrolling and doing all these things, time will just pass you by. It's a powerful statement. And the reason I said, like, with the youngsters, because you don't know. Like, I remember when I was younger, I used to think I knew a lot.
Yeah.
Right. I didn't have arrogance, luckily, but I did think I knew a lot. And I think I thought I knew how the world operated, and I thought I knew enough to be successful, but I didn't.
Yeah.
And I thought I knew that time, you know, concept of time, but you have no idea. Time, like, even now, I probably have no idea. I think it only starts to creep on you more and more as you get older. As you get older, like when we're 60 or 70, we'll even understand it more.
Yeah.
You know?
Well, I understand it more. I mean, I don't know where the last 8 months have gone.
Yeah.
You know, we're in September now, and it's like, it's crazy. Like, it only feels like yesterday I was in holiday in early June, and we're now September. It's like time just goes so quick. It's very, very scary. But we only have one life, and you just got to make the most of it. And there's 2 things that are certain, and that's birth and death. What you do in between is totally down to you. Make your mark on the world. You know, you're going to be a somebody, you're going to be a nobody. Because there's 2 ways to suffer in life. You know, you can suffer as a nobody, or you can suffer working hard. You can suffer with brutal accountability. You can suffer showing up every day. You can suffer with persistence and grit. But you could be a somebody. So we're always going to suffer in life. There's always there's 2 ways to suffer. Suffer as a nobody or suffer as a somebody. You know, the option is very clear to me on which one I would take.
Definitely. No, definitely. And it's a powerful statement. And we're coming towards the end of the podcast here, but I want to ask you the quick fire questions that we like to do towards the end.
Okay.
And one of them I had at the beginning that I've kept somehow locked in here.
Okay.
Which was, I think you have a unique perspective based on the story that we've heard today. And that is, like, does money buy happiness? Can money buy happiness?
I don't think it can buy happiness, but I think it can allow you to do things that can make you happy. So it opens up a hell of a lot more avenues for you to do things potentially. So one of the biggest things that I wanted to be able to do is help underprivileged kids. So kids in the UK, which really baffles me to this day, how, you know, kids are not, you know, being fed correctly, and we have a food shortage amongst families.
Hey, I mean, this is written by a guy from the days of bucket shops and stuff like that, and the stuff is still, you know, it really rings true. So I did have, not that I was writing a similar book, but I did have the idea that I wanted to, when I was doing these interviews, I wanted to have a goal that what I captured is something that would still be relevant 65 years from now, you know, that type of thing. I wasn't thinking of, I wasn't interested in, hey, what's the market going to do for the next year or two or whatever. I was interested in what are the truths about markets and trading that were true 100 years ago that'll be true 100 years from now. So I did have that goal. So the fact that it seems the book now, I don't know, is it 35 years or so?
Yeah.
Whatever it is. Now I think it's going this long, it might well end up being the same type of thing. So I didn't expect it, but in my mind, it was a goal.
It's so interesting what you said there in terms of you're trying to create something that has that lasting impact. So what was it that you focused on then in terms of your questioning to last that long, to stand the test of time?
The questions I'm always trying to dig at is what makes you successful where so many other people aren't? What is it, you know, that explains that? And the answers to that are things that have long-term truth, which stay true even though markets change. Market change tremendously, but yet a lot of the same principles stay true. And my explanation for that is simply that what doesn't change is human nature. You know, we may go from open outcry pits to electronic trading. We may go from no computers to supercomputers. You know, we may go from the quants being like a tiny fraction of traders to having now multiple firms with hundreds of quants working for them. So the markets change tremendously, yet some of the basic aspects of what it takes to be successful do not change at all.
It's interesting you mentioned that part in terms of the emotions, because as we continue year on year, we're starting to see a lot more capability when it comes to algorithms and AI. Do you feel like that is something that could shift that perspective or not?
Well, it's been around. We've had this quantification of trading for quite a while now, and it definitely changes things for sure, but it doesn't change it to the point where the individual trader can no longer find a successful route. So I was surprised when I did the most recent book, Unknown Market Wizards. I was kind of not expecting to find what and as the name suggests, I should explain, what I decided to do there was to really go just after solo traders, people nobody knows, and just find, but who've been very successful. So I was getting people who had very good long-term track records, but just traded on their own. Nobody knew them or anything like that. And I wasn't expecting to get like, super track records. I just expecting to get people who did a lot better than the market and stuff. And I found some of the best traders I've ever interviewed were in that book. Wow. Maybe the single best trader I ever interviewed was in that book. And that was surprising to me because I said, with all this quantification and all these hedge funds, you would think that it's now the single guy can't get spectacular results, but no, I mean, it still happens. And I think when the results are such that you could say, well, somebody's lucky, yeah, but not lucky for 18 years. And, to give some examples, I mean, one of the traders, I should preface saying, what they tend to do is also take profits out and reinvest that and not letting their account compound, otherwise it'd be impossible. But like one of the traders, a couple of traders had several 100% average annual return over 12, 15, 18 years, right? And those type of results are just completely astounding. Now, yeah, they didn't compound it, but still they're making those results. That's incredible. One trader turned 5,000 into, 50 million when I spoke to him, but in the subsequent years, I updated the book a year ago, he turned it into 250. So just totally astounding. That doesn't happen by luck.
What was your process of finding those traders? Because as you said, the unknown.
Yeah, so several ways. One, the trader I just mentioned, the one who turned the 5,000 and ultimately to $250 million, I get an email, and the trader says, and at the time, you're not going to believe my story, but I started a $5,000 account and I turned it into 50 million. And I wrote, at that time, I wasn't intending to do another. I just didn't have a plan to do another book. And I wrote him back. I said, well, that's pretty amazing. I said, I'm not planning to do another book, but I'll keep your email on file. And if I do a plan to it and you can prove it, I think that's a great story. So about a year later, I decided to do another book. And I got in touch with him, and he sent me all his monthly statements, from 2005 or 2004. I think I went something back in the mid-2000s, all the way up, 20 years worth almost. Not quite, but close to 20. Yeah. And the numbers were real, right? So that's how I didn't find him; he found me. Yeah. And that becomes by becoming recognized on a broader scale in the industry. Sort of, I have an advantage that people could find me like that, right? Yeah. Some traders I just knew. I knew the one person who really wasn't completely unknown because he had a big Twitter following was Peter Brandt. Yeah. And Peter's a friend, and I know him and all that. And I always thought to myself, and he was kind of a catalyst for doing the book, actually. I always thought he has so much wisdom about the markets. And I always thought, well, I gotta interview. And Peter's my age, so he's, getting on in years, right? And I wanted to make sure I capture what he had to say for posterity, while I could. So, but Peter's still a solo trader, doesn't manage other people's money, is not known within the broader industry, or it wasn't certainly I think before the book, but he had a large Twitter following, so he was known through that. Anyway, so that's an example of somebody I knew. And then I was involved with a firm, Fundseeder, a startup, which had a trading platform for analytical, let me back that up, had a trading platform that provided analytics for traders, all sorts of charts and analytics on their trading. It was free. The idea was that was a way to find these unknown traders. And then there was another arm of another company, Frontier Investments, that would then use that data to find traders to put together in product. And so through that, some of the traders came through that. And then I did a tweet, some tweets of my own saying, hey, I'm looking to do another book. If you are, or you know somebody who's truly an exceptional trader, long track record, is superb, return to risk, let me know. And I got a number of suggestions that way. So between those avenues, I had a book's worth of people.
And how did that compare to your first book? I know that personal connections helped you.
The first book, of course, we have no internet and we have nothing, right? So the first book, I knew some of the traders. The job I had we talked about earlier, that I landed that technical analyst job. Well, the person vacating that job was Michael Marcus, who ended up being, now he was leaving to, in quotes, become a trader. And so he was cleaning out his desk the day I came in from my first day of work. And we talked a little bit. He was still in New York for a few years, and we used to get together for lunch and stuff like that. So I knew him on a personal basis. And Michael went on to Commodities Corp, where he famously turned, well, maybe famously through my book, turned a $30,000 account into $80 million. But Michael then, he hired Bruce Governor. And so for Michael, I knew Bruce. And I think a couple of other traders, and from some of the traders, I got other traders. And so that's how I got, and then some of the traders I might have, were known at a more widely. Somebody like Jim Rogers, who was originally George Soros' partner and was, he kind of retired from that, was just managing his own money, and was teaching a course in Columbia because he wanted to teach it. And sort of I sent them my book, The Complete Guide to the Futures Markets, and say, hey, look, I'm not a journalist. I wanted to do a serious book on trade. And said, got him to. So that's how I got the people in the first book.
Do you feel, as you just mentioned there, I think that's quite interesting, is that people may have been a bit more open to your interview versus, as you say, like a journalist or something like that, because maybe there wasn't a particular angle that was going with it. It was more so, as you were saying, the value that could be given back to the wider community.
Right. I mean, yeah. So I tried to convey that I'm not trying to do any gotcha. I'm really just trying to get to the essence of trading and markets and what wisdom you might have to share. And I did something else, which I've continued to do for every book, which was to say to everybody, look, I'll send you a copy of the final draft, and you can review it if there's anything wrong, and if there's something you disagree with or whatever, we can, if it's wrong, we can change it. If we disagree with it, we can find a common agreement on how to handle that, that section or text or whatever. It came up very rarely. And so that assurance that I would let them see the final draft, that wouldn't just go out, that I think was helpful in getting the interview, but also helpful in getting them to be open, because everybody otherwise would be sort of second guessing themselves about what they're going to say if it's going to appear in print.
Yeah, in case they couldn't control or have any sort of thoughts on what was going out.
So that was I think that helped. That was helpful in getting people, and more importantly, maybe in getting them to be more open in the interviews.
Definitely. One thing you mentioned very early on there, which I found very interesting, was that at one point you didn't believe in technical analysis at all.
Right.
What changed? Like, what was it that changed for you?
So what changed it was a couple of things, and they were kind of related, and it was very pivotal for myself. I was a researcher. After a couple of years in the business, I got a job. I switched from being just an analyst to getting a job as the actual research director. Also, writing helped in that. There was a magazine at the time was called Commodities. It eventually ended up being Futures. Then eventually changed again, the name. But back then it was called Commodities. And I became a contributing editor to that. So that helped me get a job as a director of futures research. And one of my analysts was, a technical analyst called Steve Kronowitz, who became a very close friend. Steve and I shared an office, and I noticed something. I had a bunch of fundamental analysts reporting to me, and I had Steve as the only technical analyst. And of all the analysts, he was the only one who was more right than wrong, right? So I had to be open to it. I said, so Steve, tell me what you're doing, and why and what from him, first of all, I learned technical analysis, and I understood, got an appreciation of why it could work, which is simply that it's not mumbo jumbo, it's not black magic, it's the price reflects everything that happens in the market. So there's a reason to believe that the price and patterns in price could be meaningful. So that's one element of it, and I sort of started experimenting with that. But the key is, and this is really critical, and I do not mean here to demean fundamental analysis, because lots of traders I've interviewed were pure fundamental analysts and did extremely well with it. So for some people, that's the way to go. But for me, what I discovered was that besides it not being that effective, what I discovered was that it worked in contradiction almost to risk management. And one of the most important things I learned, maybe the most important thing I ever learned in my journey in interviewing traders and trading, was that it's really risk management first and foremost. You may think it's boring, you may not think it's what you're interested in, but it's the most important element. If you don't have that, you don't have anything. And what I discovered was that fundamental analysis is in many ways very difficult to make compatible with risk management. So say I think, hey, the wheat market is undervalued here. It's $5, a bushel, and I think it should be 6. Well, it goes down to 4.50, and fundamentals have not changed. What should I be doing? I should be buying more. So it's this ironic element that the more things go against you, if the fundamentals don't change, the more it would have you, adding to the position. I mean, it could be a stock as well, right? You like a stock at 50, you think it's going to 100. Well, if it goes down to 40 and nothing has really changed, you should buy more, right? And of course, that's exactly the opposite thing you should be doing from a risk management standpoint. You should be getting out or at least reducing your position if things are going against you. So, and I discovered was that it was really critical to be able to control your risk. And with technical analysis, almost by definition, if the market goes against you, then your analysis is wrong. And it works, by the way, regardless of whether you're a trend follower or a contrarian. Because let's say if you're a trend follower, it's obvious. The market breaks out. I think it's going higher. But if it comes back into the range, then something's wrong. The breakout, my assumption this was a real breakout is wrong. I'm out. Okay, so it's very easy to make the risk to pick a stop that's consistent with your analysis. Same thing if you're you're contrarian and you say, okay, this market is coming into a range where there's lots of resistance, it's oversold, it's overbought. I'm going to go short here, but it shouldn't go to new highs or something like that, or it shouldn't go X points beyond the old high. So again, you have a natural point where it shouldn't go, and if it goes there. So technical analysis is really beautifully compatible with risk management. So for me, ultimately, that became the transition where I went from being 100% fundamentals to being 100% technical. So again, and I think that may apply for a lot of people because of this risk management element. But again, there are lots of people who are pure fundamental analysts that make it work well.
It's one key theme that I noticed from the Market Wizard series is, of course, that everyone had a different style of trading, and yet they still made it work. But as you mentioned, risk management seemed to be the key theme that they would always mention in terms of what would be their advice, what would be normally their one thing. It was either risk management or a lot of the time to trade with the trend. Is that something that you noticed as well? Yeah,
well, risk management is, you talk about common denominators, it's not a 100% common denominator, but pretty darn close. It's In fact, when there was an exception, it was so glaring that it was obvious. And I can only think of, I can think of a couple of exceptions. I can think of two right off the top, but that's out of 5 books of interviews. And for almost everybody else, risk management was always really important.
I remember one particular trader, and they had mentioned in terms of, I remember actually in the interview, they only gave you a lot amount of time. I believe it was an hour or 2 maybe max. And you'd even written in the book, like you were thinking about how you might get there and it'd be more comfortable and get more time, and you couldn't do it. So what did you do in that scenario?
Yeah, so that happened several times. Several times, yeah. I mean, Richard Dennis was like that. I mean, Richard Dennis gave me an hour twice. Ray Dalio, same thing. He gave me an hour twice. Wow. So there were a couple of people that were, the worst one of all was Tom Baldwin. And Tom Baldwin, at the time, he was a pit trader in the bonds, and he traded enormous size, really enormous size. He was one of the biggest traders in the pit, just for his own account.
Wow.
I mean, he's trading the size of Morgan Stanley and Solomon Brothers, whatever, just for his own account. So, and interestingly enough, he was like, I forget what his job was. Originally, he was like working in a supermarket or something like that. So It was a really good story. So I had to get Tom, and I got Tom because there was another trader I interviewed who's was a friend, and he sort of convinced Tom to do it. And Tom didn't want to do it. So I interviewed him, and unfortunately, it makes things even worse. It was St. Patrick's Day in Chicago. When they're in the River's Green, everybody's going out to the bars. And, the interview set up obviously after market hours because he's a pit trader, right? So he comes back to the office and he's there, and he's clear he's not going to have a lot of time. And people are coming in, hey, Tom, you get to meet us, yeah, I'll be there. So I knew this was like, I said, I felt like I was a photographer who was trying to get a picture of a rare bird that was about to fly away at an instant, And I knew I just had that, before he could finish answering a question, I had to have another one. I couldn't and there was, after about 35, 40 minutes, there was one point where there was like maybe a 3-second, pause between his finished answer before I get he's gone, So that was like the toughest situation I had. But somehow I got enough to make a decent interview out of it.
Incredible.
But it would have to be very intense.
Yeah.
For that period.
Did you find that? Did you find that it was each interview kind of was a bit unique, due to, of course, different personalities, different things that impacted the interview, whether it be time or anything else? Did you find that each one you had to use a different type of either questioning or angle?
There, not so much that as one of my things that I do, and I think you do the same thing, is, in fact, you are doing the same thing, is to have a conversation, not to go in sort of a prepared, list of questions, and then go to the next question regardless of what the answer is, because the answers often lead into more interesting tangent. Sort of like you picked up on my comment about my not being a technical analysis, sort of used that as one of your questions later on. So I try to do the same thing. So that I do really just universally. But different people, there may be differences, and it has to do with the length of also the interviews. Have interviews where I know there's more stuff, but I just have to keep on as long as I don't get thrown out, just to keep the interview going. And as I mentioned to you before we started this official interview here, that one trader where first couple of hours I got nothing, and it ended up being my favorite chapter in New Market Wizard. So that has to be adjusted to the person. In some cases, it becomes almost impossible. So So there's a trader, Gary Bielfeld. This is kind of interesting. Remember, I told you I was a research director and a research analyst, and so in those days, the wires would come across. You have to do daily comments at the end of the day that would be broadcast to the brokers and all through different offices. what went on in the markets, and sometimes write a summary too. So you'd look at the wires, and I'd see, let's say the bond market. It says, okay, you see this BLH kind of being mentioned as a big trader in the bonds, along with names like Solomon Morgan and so forth. And I kind of asked, who the hell's BLH? I find out BLH is one guy in Peoria. And that's pretty interesting. So it turns out, this is the guy who started trading one lot, 2 lot corn. And by the time I get to him, and he's kind of not known of it, he's known as BLH. By the time this BLH, which is just one guy in Peoria, it's not a firm, he's trading thousands of bond contracts at a shot. And so I said, yeah, that's a story, right? That's a story. So I go to interview him, but he is, do you know like Gary Cooper from the old Westerns? He always plays these very, one-word, very quiet guys, very, very man of few words. And that was BFL. Just everything was like a 1 or 2 word, it was terrible. I just couldn't get him out. I couldn't draw anything out. There was one point in the interview, he says, well, we're talking about the analogy between poker and trading. And he said, well, could you kind of off the record? And he finally says something that's interesting. And I said, well, why didn't you want me to, you don't want me, what's wrong with that? So he says, well, I don't want to make sound like trading is gambling. I said, no, you're making good points about, probability and stuff like that. And so he let me use it. But there was so little in that interview that was like good in the interview itself, that it's the only chapter in all the Market Wizards books where my narratives is longer than the interview section.
Yes, I understand. And it's interesting you bring that up, actually, because it is actually a very interesting topic that I found, is in terms of the analogy between poker and trading, but just generally the relationship or the idea between gambling and trading. What is your opinion? You've interviewed some of the best traders in the world, and of course, some might say, they're just better gamblers, for example. But what would your thought process be on that in terms of, is trading gambling? Is it a form of gambling? Or is it just a very close relationship or line that seems to be there? Let's take a break for a minute there, guys, because I want to tell you about the best trading tool on the market, TradeZeller. The reason why TradeZeller is the #1 trading tool that every trading, and a lot of them described it as like it's a game. They would treat it as a game, right? And I found that interesting because there's a lot of traders out there who they're not passionate about the markets. They're passionate about making money, which isn't necessarily a bad thing. But I've always made the thought or put a statement of saying, if you're passionate about the money, the issue is that when you lose money, which you inevitably will in trading, especially at the beginning, what happens then? Because it's the complete opposite of your passion, because you're not making it. Versus those who are actually passionate about the market as a byproduct of that passion, eventually will make the money, as long as they have the edge, of course. What is your thoughts in terms of, you've interviewed a lot of these traders, and is that a common theme as well?
Yeah, and in fact, I think it's been a while since I looked at Market Wizards myself, but I think the very last sentence or something, one of the last sentences, you have to love what you're doing. You have to love trading. That's one of the elements that unites them. And you see it in the language. I remember Bruce Kovner talking about, trading is like a 3-dimensional chess game.
Yes.
And Jim Rogers says trading is like there's a puzzle of 10,000 pieces, and they're constantly taking away some pieces and throwing in new pieces. So what are those? Those are game-like analogies. And that kind of tells you, for the traders, this is a game. This is something, there's an enjoyment in that. Mm-hmm. And they want to, it's also a matter of figuring out things that other people don't figure out. Mm-hmm. So there's a challenge there as well, which is part of the game. So like a puzzle, right? So it's very important. I think that love of trading is really, really critical. And it's true really for not just trading, but anything. I think if you look at successful people, they're the ones who love what they're doing. And it could be anything, and they continue to do it. They might be billionaires, but they're still doing it because they just love the game, right? Which doesn't have to be trading, but in our case, we're talking about the trading, and it has to be true for trading as well as anything else. If you don't love what you're doing, don't expect to be great at it.
Did you ever come across any trader in all that time who didn't really share a strong love for trading, but still was somehow successful?
Yeah, no, I can't think of a counterexample. I can't think of a counterexample.
I think that says it all for that.
I can think of an example of a trader that was motivated. In fact, the trader we talked about earlier, in unknown market wizards, who turned 5,000 into a couple hundred million. He got into it kind of absurdly in my mind because he was out of college, didn't know what he wanted to do, and he wanted to do something where he had to make a lot of money. And I would normally tell people, hey, if you just want to get into the markets because you want to make a lot of money, you're probably going to fail. But I guess because he had some sort of innate talent. He had an innate talent of kind of picking up on trends very early before people did. He had that innate skill. And I think that's why he succeeded, but it wasn't a love of trading that got him into it. He did get in for the wrong reason, but he is the exception in that respect. And it only worked for him because he had this critical innate skill, which came out when he started trading.
Interesting. And would you say that is one question I ask a lot of traders is this actually, which is, do you think anyone can be a trader?
No. I think most people can end up being maybe net profitable, but I certainly don't believe that most people can be great traders any more than I think most people could be a great sports athlete in anything, or a great musician, or a great writer, or great anything. People have their individual talents, and a lot of the people I interviewed, I think, just had real innate skill for the markets. Now, that innate skill could be just almost an intuitive skill. Like somebody like a Marcus had that, in my mind, great intuition. He could look at, there could be 100 things affecting the market, but he would be able to pick out the one. I remember, like I mentioned, we used to have lunch together when he was still in New York, and I was a cotton analyst, and I did all this economic research. I researched every cotton market in the post-World War II period. And I came to the conclusion, well, there's only about 4 or 5 markets that were free markets, because in all those other years was the government loan program that was actually ending up providing a floor, and the price didn't mean anything. But that really, I knew it didn't, so that didn't give you much data to work with. And I kind of drew my conclusions from that, although I knew my sample was too small to be meaningful, but it's the best you can do. So we had a market where the price is like 25 or whatever, and it's kind of similar to one of the seasons where the price went to 35. So I'm bullish. Michael's bullish too. But when it goes, my opinion was to go to 35, that's going to be near a top, because that was the one analogous year we have. Michael says, no, it's going much higher because of that was the first year that China became a buyer of cotton. And he understood if all the, I did all the analysis, he didn't do any of that. But he just knew that the fact that China was a buyer in cotton, that was the key. And he stayed bullish for months and months and months. I started going short in the mid-30s, and lucky I had so little money that I was stopped out and couldn't stay short. So, and it went up to 99 cents that year. So, but he could pick. He had that intuitive skill, or he talks about in the interview, he's up late at night watching CNN or whatever, and Russia invades Afghanistan, and he immediately knows. He picks up the phone, calls the Hong Kong floor, and buys thousands of gold contracts and screws the people all the brokers who sold it to him. He said he still can't go there because because they're mad at him. Because he was the one who got him on the wrong side. So, but he had that just immediate intuition, and so you have people with that type of skill.
How important do you feel? Because it's a good example what you made there is in terms of timing. How important is timing the markets at times?
Timing, I guess, for most approaches, it's one of the key elements, and it has to do with the particular approach, the skill. So there are some approaches which are less, where timing's less important. I guess part of it depends on the approach. So not necessarily. So I'll give you an example. So it's important I think for a lot of technically oriented people, but especially on the fundamental side, not so much necessarily. So I think of somebody like Martin Taylor. Martin Taylor, for your audience sake, he was like an primarily emerging market trader. When I interviewed him, he was managing about $7 billion and was in the process of giving all that money back, except for about $1 billion, which was his own money and some close friends and investors. And the reason he did that was because he was tired of people looking at monthly returns. People have to sort of, all these allocators, particularly the institutional allocators, they're very tuned to not getting too much of a drawdown in a month or whatever. Yeah. And so, but his thinking, he was a pure fundamentalist. And by that point, he was trading both developed and emerging markets. And in the interview, this came up, his biggest trade at that point was Apple, And it was also, once in a while, his track record was very, very good. But once in a while, he'd have drawdowns into the teens. And this was one of those times. He was like down 17% or something. And almost the entire loss was due to his position in Apple. But he was like, and so his timing was off, obviously, right? Mm-hmm. But he was completely adamant that no way. I mean, he was actually, I think, adding to the position, which again, you shouldn't do from a risk management standpoint. I would say there are some exceptions that I could think of when I interviewed. He's one of them. And, but he was so confident, so sure in his analysis. He explained to me that, he knows what the forward projections are and what people at Wall Street is basing their analysis on. And he said they're just not taking into account the vast global expansion that's going to happen in Apple, particularly in China. And so he knew that was coming. He knew it wasn't factored into the market. And yes, he was saying, I'm right, the market is wrong. And so his timing was off. But 6 months after that interview, Apple had doubled by the time, doubled in that time. And so it's interesting. At the same time, his big short was RIM, which 6 months later had gone from 50 to 2, or something like that. So
it's so interesting when you talk about in terms of like risk and drawdowns, for example, because something that's very common, and I think there's a very large misconception, and I don't, as usual with trading, there's like a lot of the time not a right and wrong, but there's a big misconception in the retail space, I would say, which is like static risk, like just risking 1%. And only 1%. And anything above that is considered gambling and over-risking and dangerous. But from my experience, when not only reading your interviews and the interviews you've had, but also just either watching interviews or even some of the traders I've even met, especially the ones who have gotten the returns that a lot of people try for, the millions, the tens of millions, to the 9 figures and beyond, they talk a lot about dynamic risk. Meaning that when they have edge and they can see it and they have that gut feeling of that edge is in this trade, they then look to size in, and they'll size in a lot more heavier into those particular trades rather than just sticking static 1% consistently. What are your thoughts on that? Have you seen a pattern in that as well?
So certainly for some traders and for most traders, the idea of not risking more than a small percent, like 1% on a trade, or even a fraction of 1%, is actually a good idea. But, again, there are some important exceptions here. A number of traders have pointed out that when you have real strong confidence on a trade, you have to step on the accelerator. Like I think of particularly like Stanley Druckenmiller and talking about when he went to work at Soros Management, and he gives a story where he got very bullish on the D-mark. And this was, I think, when the wall came down and, whatever. Anyway, he goes into Soros's office and he gives him this whole pitch, and he says, and Soros asks him, how big's your position? He says, $1 billion. He says, you call that a position? So the point being, if you're that sure of this, why do you only have $1 billion on? And he says, he credits Soros with a number of things, but he credits Soros with teaching him that it's important to be a pig, when when the opportunity is there. He relates the story of Soros when the Plaza Accord back, I think it was '83, where the dollar had been strong for a long time and all the currencies were way down, and there was this accord to kind of weaken the dollar, strengthen. And I think the Japanese yen is up 700 points overnight. And Soros hears these people in his office, the traders in his office outside, are taking profits on the yen. He said, stop. Anybody who's, long the you don't want it, I'll take your position. And he said, the Fed just told me that the yen's going up for a year. Why do I want to sell it on the first day? Mm-hmm. So, that idea of really taking huge positions, for some traders, that's a key to how they get these outside returns. And Druckenmiller, who in his 30-year career before he retired to manage his own money, probably averaged close to 30% a year, pretty, on billions of dollars. Pretty impressive. But that average is, we didn't have, I think his losses, he had very few losing years, and they were small if they had them. But he did have some very outsized winning years. So it's not like he was making 30% a year, 30% a year. He had some years maybe with 80 and 90%, right? So that's where, and because when he had the opportunity, there was really a big opportunity, he would, as he said, step on the accelerator.
Yeah. Because I do find it interesting, because I do agree, like majority traders definitely should, for the majority of the time, be using that smaller risk, whether it's 1% or even lower or around that sort of average. But I do believe in terms of getting to the sort of capital, the returns that they are looking for, like the ones they strive for, is finding that edge, knowing where that edge is present, building that intuition. In terms of intuition, though, because I think that intuition is something that is quite unique, and it's kind of hard to sort of point at and say, this is how you develop that. This is how you can sort of start to trust your intuition more. Is there anything that you've found, or any of the interviews you've made where they've sort of pointed fingers to some things that have helped them to build that? Well,
intuition is an interesting thing. It's real. I mean, intuition is a real thing, and people may dismiss it. Well, intuition is kind of, that's not scientific. It's not. Mm-hmm. But people don't understand what is intuition. Intuition, in my mind, this is the way I would translate it. Intuition is subconscious experience. Mm-hmm. So it's not just something pulled out of the air. You have a hunch. Well, you may have a hunch, but there's a reason for the hunch. I mean, for a good trader, because it reminds them of something that's similar in the past. Maybe you can't identify it, but it's there, and maybe it's not in the forefront of your conscious, but you know it. And so if for some reason you think the market's going up, you have this hunch it's going to go. It's not just out of wild, blind, pulling things out of the air and stuff. It's because it's triggering something in your experience that you may not subconsciously recognize the connection, but it's there. And that's what my mind. Mm-hmm. That's what intuition is. It's that type of thing.
And did you find it was like a common theme? And they may not have specifically said intuition, but more so may have reflected it as like gut feeling, or I just knew. A lot of the time that was sort of the terminology used. It's like I just knew that this particular position or trade was going to pull through.
Well, there's an interesting element of this, that part of that also is related to the fact that we as humans just tend to have the wrong emotional response. Wrong meaning that what we want to do emotionally tends to be wrong in the markets. Mm-hmm. It's just because that's the way we're wired. As Bill Eckhart explained, that people actually do worse than random because of human emotions, because they're seeking comfort, and the market isn't paying off for seeking comfort. So you tend to want to do things that are wrong, and some people can recognize that in themselves even. And like a trader I interviewed in the last book, John Netto, mentions that let's say he finds himself that he's long gold, and the market gold runs up, and then he thinks, oh, it's going to the moon, I got to triple up, And in this case, he said when he sees them, when he goes from just kind of a solid-based opinion on the markets to kind of being, I got to get it before the market runs away, that to him is a signal that it's going to react, that he's wrong. That for the short term, at least, it's going to go the other way. So almost in that case, the intuition is tapping into your emotional response to know that that's wrong, and that you could do the opposite. So that's another form of intuition, and is that's come up a number of times in interviews, that type of thing. I've actually I just had a situation like that myself where I was looking for the dollar to, and I only trade in a hobby and just occasionally, but I was looking for the dollar to weaken. I thought that I'm going on the premise that this is top end. So I had a position in a number of currencies, all basically bearish. The dollar, and I analyzed the Swiss franc chart-wise, and I picked my point. My point was like 100 points, 150 points below the market. And I kind of recognized, though, if I get that executed, that my other positions I have on are going to lose money. So I didn't want it to be right, And my instinct when I was going through the charts was, I got to cancel this order. Mindset that you mentioned, where people say they have, a method that works and they have an edge, and that's a way. And if you, assuming that part of that is married with risk management, well, that you've just described the way of managing emotions. So if you have a specific approach and it gives you specific entries, and you always have a risk control to those entries, and you have the discipline to do the entry and the exit exactly as dictated by your approach, which has a proven edge over time, well, what you've done is you've addressed the potential psychological weakness that people have in trading. You've kind of defined it away because you're not letting emotions enter into the equation. You've got a specific entry, you've got a specific exit, and you've got the discipline to do both. So in that case, psychology no longer becomes important because you've set up the methodology to eliminate emotions from trading, which is actually a good thing.
So it is interesting because I feel like a lot of people don't focus on the most important aspect, well, not the most important aspect, but one of the most important aspects of actually having an edge first, doing the work to formulate that edge. So to know the edge, the numbers of what that should look like. And because of that, they end up having a lot of psychological issues and the emotional issues. And therefore, what they tend to do is rather than focusing on any form of the edge, they're now spending their energy on psychological issues of, okay, I'm over-risking. Why am I doing that? And then their attention's all over here versus actually having clarity in the markets of what they're looking for and why they're looking for that and how that performs already based on either past data or the data they've collected over time. Have you found from your experience that the traders that you've interviewed, they've done extensive time to formulate an edge, done the time to collect the data necessary, have really put in time before they started to make any consistent profits or huge profits? It was that they actually dedicated time and study, and it might have not been and I would like to assume it wasn't a short period of time either.
Yeah, I think that's generally true. And the amount of work can be immense. So I think of some of the traders in the last book, particularly, I know a few of them came out with binders of they would keep on all their past trades, right? So write-ups of analysis of every past trade and what they were thinking, how it worked out, just reams of, and then they review it like monthly, just so to reinforce those lessons. So there's a lot of work that typically goes in for most traders before they're successful. That's absolutely true. Yeah, that's people's misconception is that trading is an easy way to make a lot of money. That's that's what people think, but that's not reality.
One thing I've heard you, a quote that I believe you've said, but also has been reflected from one of your interviewees or one of the traders that you knew personally, was knowing where to get out before knowing, where your profit is, or before getting in. Why is that so important?
Yeah, so that's out of all the books I've written and all the advice I can give people, and I've said this before, I said, if somebody said, Jack, you got to give advice to trading, but there's only one catch here. You could only use 10 words. And I know what the 10 words would be. And it's a line that Bruce Kovner had. He was the first interview where I had that particular thought. It came up a number of times, but he was the first one. And he said, I know where you will get out before you get in. And now that's so critical for a couple of reasons. First of all, if that's true, then you've defined your risk on every trade. You can no longer have this turmoil. Should I stay with the market if it's going up? Should I get out? If I get out here, I'm going to be getting out. You've already made that decision. You don't have to kind of beat yourself up and have that mental anguish about it. You decided that before you get in. Now, here's the thing. Why is deciding that before you get in so important? Because the only time you have true objectivity is when you do not have a position. The minute you put that position on, you've lost your objectivity. Any news article comes out, you say, well, yeah, this may be bad for the position, but it's already discounted. The market already knew this, and you keep on making excuses. Everything is trying to translate it in a way that is okay for you, because that's human nature. You don't want to have made a mistake. You don't want to be wrong. So you lose your objectivity. However, if you decide before you get in, then you said, I think the market's going to go up or down or whatever it is, but if I'm right, it shouldn't go here. And you've made that in a completely rational sense because you had no horse in the race. You were fine. You were thinking purely clearly. There was no human emotion that was distorting your opinion. So that's why. That's why I say of all. There's tons of advice that are in the books, and in some books, they end the chapter. I might have like 40 points from the main point, but the single most important point that I think in all the books is that one thought.
I love that, and I think the last portion of that was so important in terms of the calm mind or the calm thoughts of, okay, before you're in the trade, you're thinking clearly, you're thinking objectively of, okay, this is the data, this is the point where the risk makes sense. But then when you're in the trade, that's when the turmoil can begin, and those thoughts of ignoring certain points and sort of having a bias and perception based on what you want to happen, you start to ignore anything opposite.
That's the trick there. Mm-hmm. Yeah, what you want to happen. Be careful. And I forget which interview it was, but somebody says, you don't want to be trading on what you want to happen. You want to be trading on what you know will happen. You got to be very cautious. And the example I gave you before, when I want to happen, I didn't want the market to be able to get to my buy point in the Swiss franc. I definitely didn't, because I knew I would be losing in the other positions. So you got to be careful about what you want. What you want is not only irrelevant but often negative to your position.
Definitely. Another sort of misconception I've seen, and it might be right for. Like, a misconception is that you can never make huge sums starting from a small sum, right? So such as 5,000 to tens of millions, for example. And that might be a right thought to have on the general basis, like for the general community. It may not be a possibility, but from a theme from a lot of traders I've seen in the book, they started very small in terms of their size. And they've ended up in a position where they're trading tens of millions, hundreds of millions, even into the billions. What do you think to that? Is that something that is the journey of that, not necessarily that they started themselves with a small capital and themselves only got it to large capital, and that due to their skill set over time and then being able to manage larger funds, take investor capital on board, that's what allowed them to scale? Or is it a possibility that traders can take small sums with the right skill set and edge and actually be able to develop to large capital?
Well, certainly, from my experience and traders I've interviewed, so I've had quite a number of traders who started with small amounts and built into large amounts. But what may also be maybe more common is not necessarily that. You also have the routes where a trader doesn't compound, as I mentioned. Quite a number of traders, because their technique, this goes all the way back to, not only the traders I interviewed more recently, but back in the original market wizard, Barney Schwartz. Barney Schwartz had this ridiculous track record for like 10 years when he was just insane. In fact, he was entering these trading contests, and they were usually 4-month contests, and sometimes they were 1 year but he was literally making hundreds of % every 4 months. It was crazy, and this was documented. And anyway, so he had this astounding percentage returns, hundreds and hundreds of % a year, and he only had like 2 losing months in that whole period, and they were minor, very small losing months. In fact, he joked those 2 months were the months his kids were born. He was distracted. So this was crazy, and people, and I know when I give a talk, sometimes I mention him as his example. I talk about Schwartz, and I say, I know the quant guys in this audience are probably thinking, hey, wait a minute, whatever it was, like 600%, 700%. Said compounded, it was. I remember the statistic. It was 25% a month.
Wow.
Over like 10 years. And I said, I know a lot of you guys are kind of thinking, gee, that 25, why doesn't he have like, 1/5 of the GNP, because he wasn't compounding. He kept on pulling money out and putting it into T-bills. He couldn't trade. He couldn't make he was a short-term S&P trader. He couldn't compound his trades like that because he would start affecting the market. So in many cases, the traders don't compound it. They have very good, tremendous return risk, but they keep the trading size not small necessarily, but it doesn't compound, right? And the other thing is where traders go into much larger size, they no longer have the same % returns. Somebody like a Bruce Sumner, when I interviewed him, I still remember he had like a decade of 88% average return. When he went and started Caxton years later and was managing tens of billions, he's not going to do 88% a year. I don't know what the track record was. I think they did fine, but God, it was nothing like his track record as an individual trader. So there are a lot of different routes on that.
What is the reason behind the fact that once the capital starts to get larger, the returns start to also reduce slightly, or
because you start to get in your own way. If you get too large, you can't just enter into the market with huge size in and out without actually impacting, creating a lot of slippage on your own. So I think you become a factor. These traders who do very well when they're not significant, they can do whatever they want. It's not going to affect the market. But if you're becoming large enough to really impact the market, then your own trading is getting in its way. So I think it's harder to manage large sums of money. Some people think, these hedge funds have an advantage. They manage the large. No, I think that's a disadvantage. I think managing large sums of money could be a problem.
Because a lot of people try and say that it's unrealistic to have even say 20% a month average return, or 40% or 50%. It's not possible, some try to say. But then again, reflecting back to a lot of traders in the book, they have these returns. They have these insanely powerful returns, insanely incredible returns. And it's not just a single trader. There's many traders who are doing it, and they're doing it on higher capital in comparison to the general audience that we have with us. But it seems to be the ones in the general audience who then try and give, not all, but some, try to give this, I would say, a limiting belief of 2% on average return is what you should be going for as a trader. Not 2% on average monthly return, is what you should be going for as a trader, 2 to 3%. Anyone who's trying to say that you can get 10% or 20% a month is unrealistic and wrong. But then when we reflect on people with proven track records and are trading actually more, so substantially more capital, they're able to achieve these returns. So,
but they are the exceptions. They are the exceptions, and you know, for most people, that would be highly unrealistic. So, is a difference between it can be done, then it can be done by most people. That's not the same thing. So, yes, it can be done. Yes, it has been done. Yes, it's being done, and yes, you may be the person that can do it, but realize that you're probably not. And it's not real. And the whole idea of targets, by the way, is not a particularly beneficial concept in my mind. And this has come up in a number of interviews. Most recently, trader Amrit Sal in the last book, who I asked him, he worked in a prop shop where he saw lots of other traders, and was asking him, well, and he's one of the traders who had I think a 300% return for well over a decade. And what was it that he saw in difference between traders who succeeded and failed? And he said one of the things about traders who failed that he noticed was they tended to have a target of making some percent every month. And his point was that if you have a target of trying to make X percent every month, you're going to be taking trades you shouldn't be trading, and that's actually going to impact your trading results negatively. Because the market, whatever your approach is, the market is not a machine that constantly favors every particular approach every month with the same potential. In fact, most approaches go through periods where there's very good opportunity and sometimes where it's very adverse to the approach. But if your mindset is, I'm going to try to make the same percent every month, then you're going to find yourself trying to, when the opportunities aren't there, taking trades that you shouldn't take and end up losing money. So the idea of targets is not a particularly beneficial one.
that is interesting, because even when it comes to capital, for the average retail trader, returns is definitely one thing that they a lot of the time put targets on. But equally, a lot of them also put targets on capital amounts due to the certain things that they have access to, whether it's the new age of what people call prop firms or these funding companies. And they put, and I believe it's a negative as well to do that, where you're saying, okay, by, 6 months' time or a year's time, I want to be managing X amount of capital. Because it's just the pressure and you're putting this weight onto your trading. And as you say, you then start to make decisions based on this thing that doesn't exist yet. And yes, it's good to have goals, but I do believe in trading, it can be very detrimental to the trader. Would you say that when people do that, so it's not very similar to the targets as you just mentioned, but when it comes to any form of sort of pressure or weight that can be added onto the trading, it's just a negative to a trader?
It's negative in the sense that the realization is the market isn't there to provide, to favor your particular approach. The market will do what it will do, and you can't force the market to fit what you want it to do. Mm-hmm. So you need to be flexible to attune to what the situation is. Mm-hmm. And if there are very few opportunities, don't trade.
What's been interesting with the Market Wizard series is that the first one was back in 79, was it?
The first one was 88. I wrote it 88. It came out 89.
89, sorry.
Yeah.
And then subsequently you did one very recently, I believe in 2019.
Yeah, 2019, and it was updated 2023.
Amazing. So in that time, though, there's been huge changes in trading, in the amount of access to trading as well, and trading styles, and maybe even new markets have occurred. Is there anything that you saw different in traders going from the original book to the latest book?
It's not really in essence. I mean, the changes that occurred, the big changes that occurred, and we talked about earlier, let's say you've gone from pit trading to electronic trading, doesn't really change the methodologies that are being used. It doesn't change how the traders are trading. The fact that we have all this computerization means that a lot of the approaches that are being used couldn't be used before because the computers weren't there to provide the data, to provide the technical analysis, whatever it might be. So in that sense, it's modified. And the fact, so let's take an example of chart analysis. Things that might have worked well 20, 30 years ago maybe don't work so well anymore. Like Peter Brandt, who is a chart analyst, bottom line. But he's clear that there's very little edge in chart analysis. All it does is it tells him which points have a potential of having a good return to risk ratio, but the predictive power is low, and a lot of the technical patterns that may have worked 20, 30 years ago, he'll say now no longer work. So he kind of focuses on those that still work. So there's adaptability. Things do change as the markets change, but not radically.
In terms of like new markets such as cryptocurrency, for example, was there anyone in the series that sort of fit into that bracket? Were trading those sort of markets?
So yeah, so I personally I didn't seek out any crypto traders per se. Some of the traders that I interviewed also will trade crypto because anything that has prices, a price chart, that trade or is affected by human emotion, they'll trade. So yeah, so some of the traders did trade crypto, but it's just another market. I didn't interview any crypto
Specific,
traders per se.
What are your thoughts in terms of like the changes you see in the industry? So yes, we've had commodities, you have futures, we have Forex, we have the currencies as a whole. We have so many markets, and then something digital comes along, which there's a lot of debates about, of course, the digital side and how much weight is there. But what are your thoughts when you see this progression and new markets forming, and a lot of it is still quite new, so a lot of it is still quite unknown, and that people do find edge there still? But what are your thoughts in terms of when you're seeing these changes within the markets?
Well, as far from a trading perspective, it's just another market. Anything that is liquid and has buyers and sellers, and you can buy and sell, and has price patterns or whatever, it becomes just another market, whether it's meaningful or not. So a lot of cryptocurrencies, in my mind, probably the majority, will ultimately be worthless. Okay. So that doesn't mean in the interim that they can't. It's true of a lot of stocks too. A lot of stocks, right? In any Fed that comes along, there's always a lot of stocks that are around that don't have any reason to exist and will burn through money and eventually go not. But while they're there, they're tradable. It's just another market. So I think crypto is in that category.
Do you think it's very similar to the .com bubble?
I do. Yeah. I do. To me, it seems that way. In the sense that, sure, you're going to have Amazons and you might, so would you translate Bitcoin or whatever it might be. So you'll have a couple maybe that survive, maybe and do maybe very well. Although I'm skeptical about that too. But I have rationalizations why it might be true. But for the most part, most of these, when there's hundreds or thousands of these, where people are just making them up as jokes and they trade huge money until they collapse. Yeah. So that has all the signs. And NFTs, just crazy, where there's no rational reason why these things should have value. So those cases, I think that eventually they just go by the wayside. So in that sense, I think it will this era of NFTs and crypto will be looked upon, even if a few of the cryptos stay extremely profitable longer term. I think for the most part, the bulk of it will be seen as a classic mania. It has all the earmarks of a classic mania.
Yeah, because the reason I made that sort of comparison is because if I remember correctly, back then there was a huge bubble. Anything with .com included on it was essentially just getting investments and was listed on the stock market and would grow, sell, and be in sort of buzzwords. But then eventually it was the ones that only really fit into society and had infrastructure, actually had value. Right. That lasted after that time.
Right. The majority went by the wayside, but there were a few that were super successful.
Yeah. In terms of GME, for example, obviously we see the rally. This was the funny thing. I watched a film, I think it was just last night we watched it, in regards, it just got made onto Netflix. and it was all about that whole situation. I didn't even realize they made a film. It was quite fast to make a film on it.
The one on GameStop.
Yes, on GameStop. It's called Dumb Money.
Yeah, I saw it.
Yeah.
It was pretty good. Yeah.
Yeah, and I found it so interesting because people debate, and the reason I'm bringing it up is because people debate quite often about the market, how it works. Is it buying and selling pressure? Is it just a reflection of emotions? Is it, nowadays it's like, is there an algorithm that delivers the price? But then when I see something like that happen, it kind of becomes more obvious of it's the relationship between the buyers and sellers. And for the most part, yes, the institutions, the big players are the ones who get to have more control of that price, just simply because of the size that they have within the markets. But then when we see a situation like this take place, it kind of, I don't know, in my opinion, it proves that the buyers and sellers are what move the charts, move the price.
Well, it's a classic demonstration of why the efficient market hypothesis is wrong. Because there are periods in the markets where prices deviate greatly from where any common sense. So there's a saying the market's always right. Well, in the sense that you can't fight price and all that, you'll lose money. But the market is not always right. I mean, traders make money by figuring out when the market is wrong. And GameStop, the idea that GameStop goes from 20 to 500 with no real change in anything, that was correct. And then when it went right back down, that was correct. No. And the same thing with the internet stocks, same thing. They go up 600%, and in 18 months they go down all the way back to where they started the index, 17 months later. No tremendous amount of news is coming in that's bullish on when they're going up. And it is that people are in this mania, oh, my neighbor's making so much money in internet stocks, or my neighbor's making money on GameStop, whatever it is, that they have to get in on the bandwagon, and somebody is finally the last one when the music stops and is left holding the bag, and it goes all the way back down again. So that whole move up and down is just nonsense. And that's essentially what was GameStop. It was just that. It was one guy influencing a bunch of other traders to take the position, shorts getting squeezed and having to then cover, and then the suckers are left. The suckers who come in $300, $400, $500 because they think it's going to 1,000 now are left holding the bag. So that's the way markets work. It's human emotion going through these manias, which happens time and time and time again.
Have we ever seen one where it happened on the same stock again? Because he's...
Yeah, well, you're seeing it now in GameStop. You're seeing it in GameStop again. Yeah.
It's so interesting.
And you have another, it's true of any meme stock. So something like DJT, right? DJT is kind of makes like $4 or $5 million and loses 400 to make it, right? It's not a business that's survivable in any sense, and yet it's trading at billions and billions of dollars. And there's no metric that can explain that. There's no metric that can explain that. So you get people doing it because they want to express their political belief or something like that. But and you see the insanity. I do have an article if people are interested. I wrote several weeks ago. I put it on LinkedIn. Why something titles like why anybody who's long DJT is a fool, and it's because the option market is kind of reflecting the insanity of it. Most cases at the market strikes and puts and calls are roughly in the same ballpark, right? But in DJT, the puts are immensely more expensive than the calls, and you think, well, why isn't that arbitraged away? It isn't arbitraged away because people can't borrow the stock and accept a tremendous cost to go short. So that's how you get that. But the option market is telling you there's an insanity here. I mean, it's so far off from any normal option behavior. It's striking. So my basic point there was, hey, if you really want to be long DJT, and he was long DJT, he says, a fool. You should basically create a synthetic arbitrage position. You should basically sell the put and buy the call. And you'll have a proxy long position, but you can actually make money because the distortion is so great that if the market doesn't come down sharply quickly enough, you might still end up making money because the puts are so expensive. So that's an example where the market inherently is telling you it's nonsense.
it's interesting you bring that up because I interviewed one trader and his style is what he refers to as glitch trading. And it was very interesting because I never thought of this as being an edge. And it'll be interesting to hear your thoughts. His whole edge is finding discrepancies in trading platforms, trading data, and then just trading that. So he goes, for example, let's say if one platform had one price, another had another, or if price was delayed on one feed, etc. He would just, that was his whole edge, was finding these glitches.
Well, that's great. That's really just an arbitrage. I mean, arbitrages are hard because they usually get traded away quickly, you know. So, but if God bless him, if he can find arbitrage opportunities in the markets, that's kind of the best. That's an ideal type of situation because by definition, there's no risk and return. But those trades don't last typically.
Yeah, exactly. That's what he was. It's like they're very quick. And what he was, because I asked the same thing, and it was so interesting because he goes that it was a big thing more so a long time ago, but the markets are more efficient now and have upgraded over time. But he said now the whole edge when it came to that is over in crypto because it's so new. It's unregulated.
That's a good point. Yeah, so I could believe that. So and that probably can exist. Exactly right. So that'll eventually get traded away. But as long as it's there, that's a great approach.
And I just found it fascinating because it goes outside sort of the general thoughts we have when it comes to edge. And I was like, wow, that's
a great approach.
It's just so different. That's what I love about the markets. That's what I love about the industry is that there is no, you have to do it this way. Just as we talked about technicals, fundamentals. One thing actually, going back to that, I think it was so interesting because there were some people you would interview where they would literally say that no one can make money just using technicals, for example, or vice versa. Like, you know, fundamentals are useless. And as an interviewer, you hear it, and yet you know it's wrong what they're saying in the sense that there are people who make money using technicals and there are people who make money just using fundamentals. And we obviously we're not trying to bring our opinion and you're not trying to convince them. But what do you think that is where people have this really strong conviction that that's not possible, but yet you know it is? But it's like their belief is literally like, even now, I've met people say scalp trading, like very quick in and out trades, it's not possible, they say. But I know scalp traders who are very good. Equally, people who don't use fundamentals, for example, they say those traders, they can't make money. But I know traders who can. And I just always find it fascinating where people are so sure and they truly believe it's not possible to make money doing these things. But as you know, me and you have known, and especially yourself from interviewing all these different types of traders, where do you think that comes from?
Because it's within their own framework of what they see and believe. That's the reality, and that's their people. And the successful traders end up trading their personality, and so part of that personality is somebody like a Jim Rogers. Part of his personality is the belief that it's all a matter of fundamentals, and that technical nonsense is just a bunch of nonsense. And for the most part, for most people, they're right. I mean, Jim Rogers' line was. I never met a rich technician except those that sell their services. Mm-hmm. That's his framework, right? And in that sense, he can find a justification because it's true. A lot of the people that are selling their services really aren't selling anything that works truly well. Mm-hmm. And so he's right, but it does not extend to the point that there aren't Marty Schwartzes out there that can make technical analysis work extremely well. So it's like sometimes when I give talks and I contrast and make the point that there's no single approach to the markets, and I actually use Schwartz and Rogers as examples. Schwartz says, I spent 10 years as a fundamental analyst and lost money every year, and I got rich as a technician. And Rogers with his cynical line about the market technicians. They're complete opposites. So who's right, who's wrong? Well, in a sense, they're both wrong about the other one's approach, but they're right for themselves. Fundamental analysis works for Rogers, technical analysis works for Schwartz, and it goes down to it being critical that every trader find an approach that works for them, and understand that whatever that approach is, there are people with completely opposite opinions of that, and it doesn't mean it can't work.
So I find it fascinating. I enjoy it because I share the same thought as like that anything can work. It really does come down to that edge. But I just always find it fascinating when I hear people say it because it's always such a strong conviction. It's not like a passing comment. It's never just like, that doesn't work. It's very much like that does not work.
And in a sense, they're right because most practitioners of both broad spectrums, fundamental analysis and technical analysis, are not successful. So in that sense, they're right. But it doesn't mean that there aren't a select minority who have an approach that does work in each category.
One thing we've seen over time, because I remember that one trader you interviewed really reflected this as well, is that they had a lot stronger edge at a particular time. And as trading became more accessible, their edge started to diminish in that side of things, and then they had to adapt. How much is the market or market participants, how much has that impacted the markets? Because there was a time where there was a much more select few who could actually trade.
Sure, it's made a big difference. Something like, take trend following as an example, okay? So, first Market Wizard's book, I'm interviewing traders who late 60s, whose track record is late 60s, 70s, 80s, right? And so from that time period. Well, you go back to then, somebody like an Ed Secoda. Ed Secoda started trading late 60s, beginning 70s, whatever, late 60s, I think. But anyway, he talks about he would get a job at a brokerage firm so he could use their mainframe over the weekend to program trend following. And he wasn't programming anything super complex. It was really just like trend following program and stuff like that. But he was one of the few people that were doing it. The people weren't doing it yet. And somebody like Marcus was also trading trends, but not doing it with a computer, but who was also kind of considered Secoda a mentor in a way. They were connected. But Marcus would, do it. He would just do it by looking at the charts and get. But that whole approach, that whole trend following approach, that was Dennis's heyday as well and stuff like that. So in that couple of decades, trend following worked really well, but it became more and more popular. And then you started getting, and particularly once you got PCs and software and charts available to everybody and all these books and all the articles. And forget nowadays with all the stuff you have. So once it becomes super popular, it no longer can maintain the same efficacy anymore. And so what happens is there is a rationale, there is a reason why trend following conceptually works. And that is because there are trends in markets. The world is filled with true trends. I mean, that's how the world works. For example, if you get a shortage in a commodity or something like that, well, let's say there's a shortage in copper. Well, it takes years to open a copper mine. The thing can develop for quite a while. And